Hello friends, welcome back to EduTap. In this session, we are going to discuss the previous year questions of finance that have appeared in the SEBI Grade A examination. And as you know, the examination is held in three phases: phase 1, phase 2, and phase 3. Phase 3 is where the interview. So in the phase 1, we have two papers, paper 1 and paper 2. So within the paper 2, we have been discussing the various PYQs with segregated into different subjects like Companies Act, economics. So this session pertains to finance section, friends. So let us proceed ahead. Before proceeding ahead, I would like to inform you about this comprehensive SEBI guidebook that has been brought. This guidebook contains all the definitive answer to all your queries. That is most often queries students ask. They keep moving from one website to another website to find their answer. But friends, we in order to save your time and effort, we have come up with the comprehensive SEBI guidebook, which will address all your queries at a single place. The good thing about this book is it is free of cost. And the second question is, where is it available? The link for the book is available in the description box below, friends. So now let us move ahead and look at the first question that appeared in the phase 1 2022. If the strike price is higher than the market price under call option, then that one will be called as. There are three types: at the money, in the money, out of the money, advance money, none of the above. So friends, I hope you are aware of this particular topic. The answer in this particular option is option C, which is out of the money. So if you are not aware, I would like to inform you. I'll just like to give you a quick recap of what is call option. So friends, this is your strike price. This is assume now you have bought a share, bought a share, bought share. Uh, that is today, which is what is the date today? It is 14th April, friends. 14th April is the date, and you realize that these prices of the shares are going to increase. So you buy an option that by 15th May I will buy the shares of a Reliance company. I will buy the shares of a Reliance company. Currently, if the today the price of the Reliance share is suppose 100, and you are under the impression that the prices are going to increase. So you make a deal that you will buy it at rupees 120. This is your strike price, and you will buy it at the 15th May. But in order to execute that deal on that particular day of 15th May, you need to pay a certain amount, which is known as premium on today, that is 14th April. Suppose assume you pay the amount of 10 rupees as premium. 10 rupees as your premium. This is your 10 rupees premium. And on that particular day, when suppose during any moment on 10th of May, the price of the Reliance share increases to 150. That is your spot price. So your spot price is 150, and your strike price is 120. And since you have paid 10 rupees as a premium, see, your effective profit is rupees 20. So friends, see, whenever the price of the spot price is greater than the strike price, obviously it would be wise enough to execute that deal. But again, suppose the strike price is 130, sorry, spot price is 130, then your strike price is 110, 120, and your premium is rupees 10. So your profit will be 0, even if the spot price, which is strike price, which is 120, if your spot price is 120, then at 120, when the spot price is equal to strike price, it is known as at the money. At the money, friends. When the spot price is greater than the strike price, it is known as in the money. In the money. And when the when the strike price is less than the spot price, it is out of the money. This is the out of the money range, friends. I hope this is very much clear. You can study it in greater details if you are not aware with the concept. I have tried to give you a brief overview of these three topics. In the money is when your in the money is one with the strike price better than the spot price for the holder of an option. Call option is when the spot price. See, since there are two types of option, call option and put option. In the money, out of the money, and at the money will vary, will vary for both the call option and the put option. In the call option, we are talking that when the spot price, as I elaborated you here about the call option. So friends, when the spot price is greater than the strike price, it is in the money. When the strike price is greater than the, or when the spot price is less than the strike price, it is out of the money. When they are equal, it is at the money. Now, having understood this, let us move on to the next question. The value of derivative, either it increases, decreases, remains constant, fluctuates with the value of underlying asset, none of the above. So friends, I would like you to pause at this particular point of time and try to answer it yourself. I hope you would have done that. The answer here is option D, friends. Derivative, as the name suggests, derivative comprises of four types: forward, future, option, and swaps. See, all the derivative, they have a certain underlying based on which they are made a derivative. Suppose now if you take the example here, the example is given that derivative of gold. We'll have gold as an underlying. We'll have gold as an underlying, and the price of the derivative will obviously depend on the price of the underlying, friends. So as the name suggests, derive their value from the underlying asset. The price of derivative depends on and fluctuates with the value of underlying asset. So hence option D is the answer. Now let us move ahead with the third question. The RBI pays interest on CRR balance to the banks at dash. Options are 2% above the market rate. Option B is repo rate. Option C is 2% below the bank rate, and no interest is paid on CRR. So as you are aware, friends, there is the right answer here is option E, because RBI has clearly mandated RBI Amendment Act 2006, which was enacted in 2006. It was decided that RBI will not pay any interest on the eligible CRR balance maintained by scheduled bank with effect from 2006. So you just need to remember the fact that RBI doesn't pay any interest on the CRR. Now let us move ahead with the next question. Identify the open mutual fund scheme where there is a 3-year lock-in period. And the options are ELSS, blue chip mutual fund, large chip mutual fund, small cap mutual funds, and option E is none of the above. The right answer here is, friend, option A, equity linked savings scheme. It is a kind of mutual fund scheme that predominantly invests in equity and equity related instruments to generate high returns. So what makes ELSS, that is ELSS, different from other equity mutual fund is that, see, this is a other equity mutual fund. There can be again different types of debt mutual fund. So be aware of the terms that you read. Now here the investment up to rupees 1.5 lakh under this ELSS scheme is eligible for tax deduction for taxable income. The schemes comes up with the statutory lock-in period of 3 years for each SIP. It is the only mutual fund scheme that qualifies for tax deduction under section 80C of IT Act. So friends, I would like to just give a quick information regarding mutual funds. There are of two type mutual funds. One is open-ended mutual fund and other is close-ended mutual fund. See, these are not traded on this stock exchange, whereas these are traded on the stock exchange. Apart from this, you can go and dig in deeper information regarding the type of mutual fund. You just need to be aware that these are the various type of mutual fund, and ELSS is also a type of mutual fund which is under equity mutual fund. And what is so special about ELSS is that there is a lock-in period of 3 years, and apart from that, the investments made under the ELSS are eligible for tax deduction. Now let us move ahead with the next question. Fifth question is, which of the following is not correctly matched? RBI is the regulator of monetary policy in India. SEBI is the regulator of capital markets in India. IRDAI, that is Insurance Regulatory Development Authority of India, is the regulator of insurance market in India. AMFI is the regulator of mutual fund. PFRDA is the regulator of pension sector in India. So friends, the right answer here is option D, because the regulator of mutual fund is SEBI, not the AMFI. AMFI, what exactly is AMFI? So Association of Mutual Funds in India is dedicated to developing the Indian mutual fund industry on professional, healthy and ethical lines, and to enhance and maintain standards in all areas with a view to protect the interest of the mutual fund and their unit holder. So you can study about AMFI. and these are the four regulators, four financial regulators in India. One is RBI banking regulator, SEBI capital market, IRDA pension insurance regulator, and PFRDA is pension sector regulator. So friends, now let us move ahead with the next question. SEBI has unveiled a framework for making operational gold exchange, which will facilitate the trading of yellow metal in the form of dash. And the options are exchange trade gold receipt, exchangeable gold receipt, equity gold receipt, electronic gold receipt, and the option E is none of the above, friends. The right answer here is option D. So this was a current affairs question which was in news during the 2022. So it gave market regulator SEBI gave go ahead to the BSE to launch trading in electronic gold receipt, paving the way for exchange to launch spot bullion exchange, friends. I hope this is very much clear. And SEBI has clearly defined, finance ministry has included EGR, that is electronic gold receipt, under the definition of securities, which has been defined under section 2 of the Securities Contract Regulation Act 1956. Now let us move ahead with the next question, friends. With respect to alternative investment fund, no scheme shall have more than dash angel investor. So again, this was a tricky question that was asked in the phase 1 of 2022. The answer here is option A. So the limit was increased to 200 from 49, but 200 was not given in the option. Therefore, the best option is 49. And here is a snippet of the news from which the question was asked. You can go through that, friends. There is nothing much to explain here. So that's all we have in this particular session. I hope you enjoyed this session, friends. Thank you.